Welcome to The Explainer. Today we're unpacking a really fascinating and highly debated name in the trading space, NYS Markets. Launched in 2025, this simulated prop firm has generated a massive amount of buzz online. They offer a simulated trading environment where you can access virtual capital across forex, indices, and crypto, with the potential to earn real profit splits. But, as with any prop firm, the flashy marketing claims on the front page don't always tell the whole story. So, we're going to look at the exact mechanics of their platform, their risk rules, and crucially, what actual users are experiencing on the ground. All right, let's dive right in.
Here's our roadmap for today. We'll start with the NYS Markets promise, get into the technicals of surviving the drawdown math, and then uncover the hidden rules. After that, we'll break down the payout process and finish up with the Trustpilot reality check.
Let's start with Section 1, the NYS Markets promise, simulated capital, real potential. When you first look at NYS Markets, they position themselves as a fast, accessible route for traders who already have a working strategy and literally just need the capital to execute it. Prop firm Bridge, which is a major reviewer in this space, actually gave NYS Markets a very solid 84 out of 100 score. That high rating is driven by the firm's accessible evaluation structure and the speed of their payout systems. And for a newer firm, establishing this kind of attractive facade is absolutely crucial. They've built a platform that looks highly competitive against industry standards, offering familiar CFD platform options like MT5, MatchTrader, and TradingView.
Now that high rating translates into three distinct account offerings. First up is the instant account. There's no profit target, you get immediate funded access, but you do face a trailing drawdown. Then there's the Step 1 challenge, which is a single-phase evaluation requiring a 10% profit target with a minimum of 3 trading days, also using that trailing drawdown. Finally, the Step 2 challenge offers a traditional two-phase path. It requires slightly lower profit targets, but provides wider, static drawdown limits. It's a nicely structured setup designed to cater to everyone from the impatient expert right down to the cautious beginner.
But getting an account is one thing. Keeping it is something else entirely. Welcome to Section 2, Surviving the Drawdown Math and the 3% Daily Loss Trap.
The absolute most dangerous hurdle here is the trailing drawdown. On the Step 1 and instant accounts, your maximum loss limit is not static. Let's say you have a $100,000 account and a 6% maximum drawdown. Your floor starts at $94,000. But if you make a great trade and your equity peaks at $105,000, your drawdown floor trails upward right behind it. So the crucial takeaway here is that your risk buffer literally shrinks as you build profits. Unless you withdraw those profits to reset your base, you're basically constantly running from a rising floor. This unexpectedly punishes profitable traders who let their guard down even for a second.
And here is where the math gets even more dangerous for the unwary trader. NYS Markets calculates your strict 3% daily loss limit based on equity, not balance. Now, balance only reflects your closed trades. Equity includes your real-time, open floating profits and losses. So if your balance is $100,000, but you have an open trade temporarily sitting at a $3,000 loss, your equity has just hit that 3% daily limit. Boom! Your account is breached and terminated instantly. So many traders falsely rely on their closed balance and just get completely wiped out by standard intraday volatility spikes.
Which leads us directly into Section 3, Hidden Rules and Restrictions, what the dashboard doesn't show.
Let's look at the specific triggers. The automated risk engine at NYS Markets is ruthless, and it triggers without any manual warnings whatsoever. They enforce both soft and hard breaches. Overscaling your position sizes dramatically or showing wild swings in your trade frequency, that violates their consistency rules. Masking your location with a VPN or logging in from multiple countries, that will flag your IP. And hard breaches like hedging, holding offsetting positions to manipulate your drawdown, or latency arbitrage will get your account instantly revoked.
To highlight just how hyper-specific these rules get, here's a direct quote from a review by the YouTube channel Daily by Sumit. They noted, "You can trade during news events. Just one criteria. 5 minutes before and after you must not execute any new trades. Now, while your existing trades can hit their stop loss or take profit during this 10-minute window, clicking buy or sell within 5 minutes of high-impact news is a direct violation. You basically have to trade with extreme robotic precision to stay compliant."
Now, if you can manage to navigate all those hidden rules, you reach Section 4, the payout process, unlocking your profit split.
Unlocking your payout is a strict sequential process. First, you have to complete the minimum trading days, for instance, 3 active days on the Step 1 challenge. Second, you must accumulate enough profit to actually cross their minimum withdrawal threshold. And third, your account must be in full compliance. That means no soft breaches or consistency flags pending review. If you pass all these gates, the rewards are actually highly competitive. Profit splits start at 80% for the trader and can scale all the way up to 100% based on consistent performance.
And here is the crowning jewel of their marketing: 24 hours. NYS Markets heavily markets the promise that once your payout is fully approved on their weekly cycle, it's processed in under 24 hours. They offer a really wide array of payment methods, from standard bank transfers and cards to e-wallets like Skrill. On paper, it's an incredibly efficient system.
But how does this heavily marketed, technically complex system actually perform in the real world? Let's look at Section 5, the Trustpilot reality check, and what traders are actually saying.
The reality is, frankly, a bit jarring. Out of over 680 reviews, NYS Markets currently sits at a 2.3 out of 5 on Trustpilot. A staggering 51% of traders gave the firm a 1-star rating. That means over half of the users out there felt their experience warranted the absolute lowest possible score. Let's look at exactly what these traders are reporting.
Take a look at this direct quote from a trader who participated in a promotional giveaway. The user writes that they were promised a free funded account, passed the challenge in a disciplined way, but then were suddenly hit with a $110 activation fee. This kind of bait-and-switch tactic for promotional accounts is a recurring theme in the negative reviews, and it obviously leaves a really sour taste for traders who put in the work expecting a truly free challenge.
And it gets even more complicated when we look at that vaunted payout system. Another user detailed a catastrophic crypto payout mismatch. They requested a $1,600 payout in Ethereum, provided an Ethereum wallet address, but the firm sent the funds as USDT on a network that the receiving wallet simply did not support. The funds were lost. We're just letting the evidence speak for itself here, but it highlights severe operational friction happening at the exact moment a trader is finally supposed to be rewarded.
Summarizing the broader themes from Trustpilot, a pretty clear picture of operational chaos emerges. Traders are reporting active, funded accounts just vanishing from their dashboards without any explanation. In another incident, a 100% discount code, BCL Elite, was publicly circulated, used by traders, and then retroactively revoked by the firm as an internal testing mistake. Add to this widespread reports of completely unresponsive customer support and dashboard data glitches, and the friction becomes undeniable.
Which leaves us with a provocative final question. We've seen the brilliant upside today: an 84 out of 100 reviewer score, rapid 24-hour payouts, and a profit split that can scale to 100%. But we've also seen the brutal reality: shrinking trailing drawdowns, unforgiving hidden rules, and a Trustpilot page dominated by 1-star reviews citing missing funds and vanishing accounts. So is the simulated risk actually worth the 100% split? Well, that's a calculation every trader is going to have to make for themselves. Thank you for joining me for this explainer, and remember to always keep questioning the details.